Hey everybody, Christopher K. Smith. This is my Fiblines quarterly update for March 29th of 2020. And it's certainly been an eventful start to our new decade here. Stocks have completely gotten whacked in ways that nobody really would have expected due to this COVID-19 situation. So um, taking a look at the larger picture here, I like to look at the stock market in terms of pre-Trump and after Trump. So this is the low that we had back in, I think it was the end of October of 2016, just about when Trump got elected. See, from there we had a huge rally up here. Had a brutal sell-off back here in late 2018. Recovered all that pretty quickly, ran up to a new all-time high here just back earlier in February, and just got whacked down here due to this whole coronavirus situation. Completely taken out of the blue. I don't think anybody expected this. I think even Ray Dalio got his butt kicked on this one. But it's interesting to see how far it set us back in terms of this rally that we've had. And in terms of, I'll show you at a comparison, but for the SPY, we haven't quite made it back to Trump, the levels where we were when before Trump got elected. For the Dow, we briefly kind of moved through that area and then moved back up in the last week's flush. And the IWM, of course, has got all the way back down there. So let's look at comparison, relative comparison of this sell-off. And from when Trump got elected to the recent all-time high, the SPY was up about 60%. The Dow about 65%. IWM relatively underperforming, up about 50%. And the Qs trouncing them all up 106% since Trump got elected to the recent all-time high. So here's the sell-offs we've had, and here's the percentage of sell-offs. SPY is giving back about 25%, DIA about 27%. IWM gave back 35%, so selling off even more than the other ones. And the Q's selling off only about 20% from the recent high. And so looking how far back in time did that set you in terms of this rally? Well, the SPY set you back to basically the beginning of 2019, so essentially it gave back a year and 3 months worth of gains there. It set the Dow back to 2017 levels and set the IWM back to 2016 levels. It's actually pre-Trump era. So you can see the IWM has been underperforming versus the other ones, both in terms of the amount that they rallied in the Trump rally and then the amount that they sold off in the sell-off. And you can see from this chart here that IWM is really back. Well, at least this recent lowest flush we had recently was before, way before Trump even got elected. So the broader market is characterized by the IWM. It's a broader index, 2,000 stocks. It's really been underperforming versus the other indexes for some time. And the Qs you could see has been trouncing them all, both in terms of the amount that it rallied and the small amount that it pulled back compared to the other ones. And I think that's because a lot of the wealth is concentrating in fewer and fewer stocks, Amazon, Apple, Netflix, and Google. And they're becoming a larger and larger percentage of the stock market, just on dollar terms, but not necessarily in broad participation of the markets themselves. So anyway, so that's where we were in terms of sell-off. So this sell-off, as bad as it's been, it really only just set us back to 2019 levels in terms of the SPY. Essentially, we gave back what we made last year and then some. And that's about right for my portfolio also. I'm down about 15% for the year at this point. That's about as much as I made last year. So basically, I'm just set back to beginning of 2019 levels. And that's it. So let's take a look at some stocks. In terms of how we did, in terms of how we did with the Fiblines, the IWM was definitely the most representative in terms of how well it called the tops and the bottoms. SPY, not so much. Dow, not so much. The Qs, we kind of had a nice little 3-bar deflection off this yellow line up there. So let's take a look at some individual stocks. And we looked at the indexes. General Electric. Now, General Electric's been in recovery for a long period of time. And wrong symbol. And we knew there was going to be a time at which she just got the baby thrown out with the bathwater, and that was pretty much this low down here. You never know that when that is until it's in retrospect. And as the stock was rallying up, I was thinking, gee, well, I guess that was really the low there, and that was right about this 680 level, 670 level. And as it rallied back up, that looked like it was a good low, and then recently we got sold back just to this point, basically right back to that point there. So I think GE is really, its company's not going out of business. This stock gets played a lot by institutions and hedge funds because it's such a low price stock. You can buy so many options with it. So I think it's a good time to buy some GE, sell some puts, buy some calls, get a position size in there that, in 6 months or so could be a double without having to risk a lot of money. So that's General Electric. Amazon, I've been with Amazon the whole time. Now you got to ask yourself in this environment, which our company's going to do more business or less. I think Amazon's going to do more. Facebook's another one. We'll look at that in a minute. Amazon got whacked pretty hard all the way from this recent rally after the earnings was about $2,200 a share, all the way back to about 16, about a 25% sell-off there, and rallied back about half of that. So Amazon, I think, is going to continue to do well. You're going to see new all-time highs here. It's just a question of time. I'm up a little on the stock. I'm sticking with it. Facebook. Been with Facebook for a long time. Got shaken out down here in this sell-off down to the 150 area. As it rallied back up, I said to myself, gee, I really should have picked some up down in the 150 area. It was such a great, if I really believed in the value of the company, which I do. Great time to buy it down in the 150s. Well, guess what? It's back down here in the 150s. So it's time to get long some Facebook. I think Facebook's going to do more business in an environment like this than less. I mean, obviously, as the economy contracts to the degree that it will, Facebook will sell less advertising, but I have a lot of faith in this company. I'm going to get long some Facebook here. What else? NCLH, man, this cruise companies, travel, anything entertainment related, really took a bath. And NCL got sold off all the way down here to the 10 area from a recent high of 60. This industry really got hit hard with the COVID-19. You get a bunch of people on a cruise ship with a virus. I mean, nothing good can come from it. And now they have a lot of expensive inventory that's sitting around that costs $10,000 an hour to run these boats. Not to mention the debt servicing. Nobody's working. It's a bad situation. But I think it's a good time to just hold your nose and buy 100 shares because it's going to come back. It's going to come back strong when it does. It's going to take some time, but I think it's going to be a moneymaker long term. PayPal. I was fortunate enough to have sold that one up in the 106 range. I missed the rally up to the 120s, but it's back down to a more reasonable price here, so I think PayPal is going to be a winner. And what else? CVS. I was patting myself on the back here when I bought CVS at 55, whatever. Felt really smart up at 70. Rallied all the way back down to the 50 area, and I've stuck with it the whole time, so I'm essentially still long with Facebook. I like the company. I think it's coming back. What else? Apple. Apple also got whacked tremendously, all the way down from 300, flushed all the way back here to about 213. That's almost a 30% sell-off. Rallied some of it back. Nasty. What else? Citrix Systems. What kind of stocks are at new all-time highs in this environment? Citrix Systems, CTXS, they sell remote control software. I haven't looked at the news. I don't know if it's a takeout offer or what, but CVS at a new all-time high. TDOC, TDOC, I reworked in this this release, and I reworked the highs and the lows here. I had earlier had a wave one way back here in the single digits. This now is on fire. I think it's got a target up in the 211s for TDOC, TDOC. What else? Yeah, the Treasury bond ETFs, TLT, IEF, and SHY have held up incredibly well. They're actually close to all-time highs here, and it goes to show you that these don't yield as much as the bond funds, but they do have stability. They yield less, but they're more stable and actually rally when times get tough and everybody runs for liquidity. So of the three, SHY, which is the short-term one, the 1 to 3 year, actually has a higher yield than the longer-term ones. This is about 2.01. The longer-term ones are in the 1.85. I think that's what they call an inverted yield curve. I think that's supposed to forecast a recession. And yeah, that traditional bond funds got whacked. I'm into bond, BOND. That sold off about 15% in one big shot and kind of flushed in one bag flush, came back in, did all half of it back. And another one I'm into is ANGL, which is a higher risk bond fund with a higher yield. That got whacked down about 30%, rallied about a third of that back. And the last one was BAB, Build America Bond. That got whacked, but not quite as bad. Recovered most of that back. So I believe that's about it. Looked at Zoom, and oh yeah, Zoom is a new symbol I added this time around. ZM. Yeah, with all this remote teaching and learning going on, Zoom's company, they had an IPO, I believe, back here in 2019. down here at the 60 level, rallied up to about 120. So this is a brand new stock, new interpretation, and here's your wave 1. Here's your 161 line. Your 261's up here at about 176. So that's your next target on Zoom, which is a video company. Do video conferencing solutions, and my company that I work for was also looking at Zoom prior to this whole COVID-19 crisis. So solid product, solid company, and certainly in the right place at the right time. Now in terms of Fiblines, you can get them up here at fibtools.sells.com. It's a combination technical indicator and interpretation, all built in. It's a support for about 200 symbols in the indicator. And for $99 you get essentially a subscription, 4 quarterly updates. This is my March 2020 update. And you can get that at fibtools.sells.com for $99 for one subscription. Thanks very much for watching. Good trading and have a great day.